Hello, my friends. Today is March 20th, and this is my March FOMC debrief. Now, today's meeting was, in a word, bullish. Now, before we get into what actually happened, let's level set a little bit. So, over the past 2 months, we've had inflation pretty much consistently come in hotter than expected, be it CPI, PCE, or PPI, or even input prices. Secondly, it seems like over the past 2 months, financial conditions have loosened quite a bit. If you look at equities, it looks like the stock market is going to the moon, credit spreads are very narrow, and we even had dog with hat make an appearance on the Las Vegas sphere. So there was some expectation going to this meeting that maybe it might be a bit hawkish to try to check the market a little bit, but that did not happen, not even a bit. And I tried to warn you guys. So let's move on and talk about what actually happened today. Let's do this in two parts. First, let's talk about the dot plot. And secondly, let's talk about what happened at the presser. So the dot plot is a document that the Fed puts out every quarter. And on the dot plot, each FOMC participant marks down where they think interest rates, growth, inflation, etc. will be for the next few years. The first thing you want to focus on in the dot plot is what the median dot is guiding towards in terms of rate cuts this year. Now, in December, the median dot guided towards 3 cuts this year. Today, that median dot is unchanged. Now, that was the window where there could have been a hawkish surprise, such as if the median were to shift towards 2 cuts this year instead of 3, but that did not happen. The second thing I thought noteworthy in the dot plot was that the expectations for GDP were revised higher, and notably so. In fact, if you look at the median expectations for GDP this year and the next 2 years, you'll notice that they are all above 2%. That is to say, the median person on the FOMC no longer expects a recession. A recession would be when GDP growth was below potential, so below 1.8%. And if the median person expects GDP to be 2% or above for the next few years, then they are no longer expecting a recession. Now, related to that, we also see inflation expected to be slightly higher this year, not this year, next year than they did last time, but only slightly so. So I don't think it's a big deal. Now, the last thing that I thought was pretty interesting was that the long-term neutral rate for the median FOMC participant was revised ever so slightly higher from 2.5% to 2.6%. So the neutral rate is basically an imaginary rate that the Fed uses as a benchmark to know whether or not monetary policy is restrictive or accommodative. So if you set monetary policy above what you think of as neutral, you're basically doing restrictive monetary policy and trying to slow the economy down. And if you set policy below neutral, you are easing policy and trying to boost the economy. Now, it seems like there are people on the Fed noticing that, hey, over the past 2 years, interest rates were 5%, but the economy continues to do well. So maybe the economy is not as sensitive to interest rates. Or another way to say that is maybe the neutral rate is higher than we thought it was. And so we have that median move from 2.5 to 2.6, which is barely anything at all. And in my personal view, neutral is much higher than 2.6. And that just means stocks are going to go even higher because they have this policy error. Okay, let's get into what Jay Powell was talking about at the press conference. Now, the most notable thing at the press conference was, as Chair Powell had teased the last time we had the last meeting, they did have a discussion as to what to do with QT going forward. And Chair Powell very strongly hinted that at the next meeting, they're going to taper QT. Now, he was careful to say that, tapering it doesn't mean that we're just going to end it, right? Maybe when we taper it, it's so that we can go even further, because by tapering it, we're making it so that a QT doesn't cause any unexpected blow-ups that would force us to stop the process. And so by tapering QT, maybe we can go longer. So in that sense, he's kind of trying to soften the implications of this. Again, if we are tapering QT, the Fed is shrinking its balance sheet at a smaller pace. Again, the supply of treasuries going to the private sector is going to decrease because the Fed is not going to be shrinking its balance sheet as much. So that's, unambiguously easing policy. He softens that a little bit by saying that, hey, maybe that means we'll do QT for a longer period of time, but that's so far into the future, I don't think it's impactful. So I view this as a dovish move. And we also had a couple interesting questions that were able to get some candid responses from Chair Powell. The first, of course, is addressing what many people are thinking. Well, Chair Powell, we got, inflation was a, pretty hot prince for January and February. Why aren't you changing your stance of policy? And to which he replied,
I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%.
Basically, he's telling you that, we were always expecting data to be a bit more bumpy, so not a big deal. Let's see what happens. So he was willing to shrug it off, basically. And only 2 months, I think that's understandable. Now, the second thing he was basically asked about was how he felt about financial conditions. Obviously, many people look at what's happening in the markets and think that financial conditions are loose. What does Chair Powell think?
Ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate.
So Chair Powell basically is telling you that he thinks financial conditions are restrictive. I don't know why he thinks that. I think it probably has to do with where he thinks neutral rate is or something like that. Or maybe it's just an excuse because he just doesn't want to do anything about the stance of monetary policy. But, he's been very consistent, and so have many other people on the FOMC. Notwithstanding what market participants look at, say equity prices, credit spreads, and so forth, people on the FOMC have been very consistent in telling you that they think the policy is restrictive. So, that's that. And that's kind of why I think we're just going to go into crash out mode again. So on the one hand, Fed is being dovish now. That I think that's really good for asset prices. Probably not good for inflation. I'm thinking that we're probably going to stabilize between 3 and 4% inflation, but I don't think that's going to be apparent until later on in the year. And then I think the Fed will have to reassess how they think about the world. But until then, all right, thanks for tuning in. Be back this weekend for Markets Weekly.